Good morning. It's Jeffrey Christian of CPM Group. It's about 10:50 in the morning on Friday, the 27th of October here in New York. Gold and silver are off slightly today, but I'm not going to really talk about the markets right now. There are a few questions that were made to us in comments that I want to address. And one of them had to do with trying to explain the commitment of traders reports and how it is that some people get it so wrong. And why. So I'm going to spend some time on that. It may be a little bit of a long presentation. I apologize for that, but knowledge hurts. First one is a fellow named Rob who said, look, the key point here is, don't you think that the uncertainty about U.S. debt is a reason to buy more gold? And that's exactly the point CPM Group has been making. We've been making it very strongly in the two market alerts that we released in October for our clients. We've been making it very strongly in presentations that we make for other clients, including clients that then distribute those presentations. And we've been making it very clear and strong in these videos. That's exactly the point we've been making. Rob, thank you. Yes. Look at the world around you. Don't look just at the U.S. debt. Yeah, U.S. federal debt is now 122% of GDP, as high as it was in 1947. We know exactly how to fix it. It's just that all the addicts that live in America don't want to do the simple things that need to be done to restore fiscal order. But look at global debt. Not just U.S. government debt, not just U.S. total debt, including consumers and corporations. Look at a global debt where you have global debt, which is roughly 3 times global GDP. And most of those people have far worse credit ratings than the U.S. Treasury. That's a scarier problem to deal with. And all of this makes a very compelling reason to own gold and to have some of your wealth stored in gold. So thanks, Rob. Second one was, I want to know from Mr. Christian, what happens? Janelle puts out a bunch of notes and nobody wants to buy them. And that's an interesting one. First off, it's extremely offensive for someone to use diminutive terms like Janelle. You know, Janet Yellen knows more than you will ever know about finance, and you should show her some respect. Second thing is, your question is more important than the answer. Now, I've shown this chart in the last couple of weeks, and you can see that, well, you can't see because it's very small, but the red line is a moving average of the blue line, which is the amount of treasuries that are asked to be bought at treasury auctions versus the amount that actually is being sold or offered to be sold by the U.S. Treasury. And it's about 2.5 times as much. People want to buy about 2.5 times as much U.S. Treasury notes at auctions than the U.S. Treasury is selling. Now, that's down from the period of, say, 2010 to 2014, as you can see here, sort of. But it is higher than it was for much of the period throughout the 90s up until 2010, 2014. The reality is that U.S. Treasuries are the best of the worst sovereign debt offerings. They have the highest credit worthiness, and they are considered the closest thing to risk-free debt. And you will not be alive when the time comes when people don't want to buy U.S. Treasury debts. It probably will come, but it's going to be sometime in the distant future. The fact that you asked this question reveals the biases and the lack of understanding of Treasury's role in financial markets on a global basis. If you understood that stuff, you wouldn't ask this question. It's an irrelevant question. I hate to be rude, I hate to be blunt, but sometimes you just have to smack the sense into somebody. You know, you are seeking confirmation for something that's spurious, that only promoter boys on the internet talk about. You are not asking the right questions in order to manage your wealth well. I'm sorry, but that's the way it is. Now, inner path, I'm not sure where that path leads to, asked if we could do an educational video explaining commitments of traders. He's confused because we have one view of what the commitment of traders reports are, and it is quite different from what he calls previous mentals YouTube influencers. And he wants me to be the devil's advocate and explain it from both perspectives. I will spend most of this video talking about it from the reality side of the market. It's kind of hard for me to spend a lot of time talking about imaginary nonsense, to put it nicely. Okay, I can try to explain it from both perspectives, and I'll go through that. And hopefully at the end of this video, you'll understand it a lot better. First, what are the commitment of traders reports? I don't think most people know, including some of those influencers you were referring to. On a weekly basis, the various futures and options exchanges that are regulated by the CFTC in the United States have to collect data on who's trading all of the different commodities and financial futures and options on their things and give that to the CFTC. So the data originates with the members of those exchanges who file reports with the exchanges, who collate those reports and then give them to the CFTC. And it tells you long and short positions of commercial companies or bona fide hedgers or companies that have a commercial interest in being involved in futures and options, and investors. And there's short and large investors, and then there's a residual, which are smaller investors who are sub-threshold reporting requirements. So that's what the commitment of traders reports are. Now, why do commercials trade futures and options? In order to understand what's going on, you really have to understand what that's there. Commercial companies trade in the physical market. And you have to understand what mine production, smelters, refiners, fabricators, and wholesalers, retailers all do and how that works. And how it's all financed, because the futures and options markets exist to finance, to hedge the financing of commodities trading across all commodities. There are two commercial services provided by commercial traders that trade futures and options. And you have to understand why they trade those futures and options. The first one is to hedge their own physical holdings and transactions. And I've talked about this ad nauseum. There are enormous amounts, there's like more than 5 billion ounces of physical refined silver in the world, and perhaps 1 billion of that is owned by banks and trading companies that lease it out to miners, smelters, refiners, fabricators, wholesalers, retailers. They have an enormous physical position, and as I'll talk about later, they're required to hedge it by their lenders. The second thing that they do is they provide liquidity, or the other side, for investors. And investors tend to trade long. A lot of investors don't feel comfortable shorting assets or going short. So investors tend to trade long historically across commodities. And in order for an investor to be long a futures, somebody has to be short. And one of the things that commercials do is, if somebody wants to be long, they will sell them a futures contract. If someone wants to be short, they'll buy a futures contract. So they're providing the liquidity that allows investors to participate in these markets. And who are the commercials? We point this out because there are these internet experts, or what was somebody, one of the earlier questions, mentals. There were internet experts during the silver squeeze, Wall Street silver hoopla a couple of years ago, who questioned why banks and trading companies were allowed to trade metal and be included in the data as commercials, not realizing that virtually all of the commercial trades are undertaken by banks, brokers, traders, and other financial commercial intermediaries. Yeah, mining companies, smelters, refiners, processors, fabricators, wholesalers, retailers, most of them do not get involved in futures and options trading. They will do a forward contract with a bank, a broker, a trading company, and leave the futures hedging to their financial counterparty. If you live where I do, and you get involved with professional market researchers, and there aren't a lot of them, the question is not why commercials have such large future positions. The question is, where's the rest of the hedging value? Because the short positions that you see on the futures market don't necessarily account for what you would expect these guys to be hedging. And the answer is, well, some of it is cross-hedged within the futures and options market, but there's also forwards and options and ETFs and ETF options that these guys use to hedge their physical positions. Now, a couple other points to understand. Commercial traders in the futures and options markets primarily are banks and trading companies. Across commodities markets, typically only about 2 to 6 commercials are engaged in each commodity market and have most of the trading volume. I've showed data repeatedly over the past 2-3 decades showing that the concentration of long and short positions among commercial traders on gold and silver and platinum and palladium are not excessively out of line with the concentration of trades in oats and soybeans and corn and oil and copper and other commodities. In fact, they're right in the middle, gold and silver. So the concentration exists across commodities markets as it does across banking services. There are only like 3 or 4 banks left that will hold residential mortgages. Other banks will sell you a mortgage or process a mortgage, and they immediately sell it to those other banks. There's a very high degree, a dangerously high degree of concentration across banking services. And that is what you're seeing with the fact that there are only a handful of companies. Now, if you are a demagogue or a propagandist or a influencer who's trying to do stuff and you don't understand that, you'll make a big hoopla out of it. But if you understand the bolts and nuts of the banking industry and the commodities futures markets, you'll understand it's not a big deal. And we'll get to that in our conclusion. These commercial traders are long billions of dollars of each of those commodities. These commercial traders use billions of dollars of borrowed money to finance their business operations. Their lenders insist that their physical positions be hedged constantly on a daily basis. You don't go home long or short if you're borrowing money from me to finance your commercial operation. As a consequence, there are virtually no naked short commercial futures and options positions. If you don't understand that, you get it wrong. It's that simple, okay? So let's see. Now, to understand the markets, here you go. 130 million ounces of gold supply. Mine production around 90 million ounces. Secondary supply around 25 million ounces. 130 million ounces of annual new supply coming into the market and then going through the processes. Yeah, the miners need to finance their operations. The smelters need to finance and hedge their operations. The refiners need to do that. So it's 130 times 3 right there on the supply side. Who do they do that with? Commercials. What kind of commercials? Banks and trading companies. Another 100 million ounces of fabrication demand. Again, going through several companies, all needing to be hedged and financed. Silver supply, roughly 1 billion ounces. Same story. And silver fabrication demand, roughly 900 million ounces. The same story. There's an enormous amount and an exorbitant value of gold and silver in the physical market. And commercial banks and trading companies provide financing services to the companies that are producing, processing, using that metal. And that's why futures markets exist. Futures markets were created to provide hedging capacity for trading companies 500-600 years ago. All that metal has to be financed. And that's where it comes from. Now, a couple things. This is an old chart. This is like from the 2000. Well, it's the prices were $16, $31. This is like from 2012, 2011. Banks make money by lending out dollars, gold, and silver. They charge a fee, typically a percentage of the value of the transaction. They have a lot of silver and a lot of gold that they own that they're leasing out to their clients, and they're charging, 1% or 3%. Let's say that they're leasing silver and it's 3%. Price is $16 here, 3% interest, 51 cents an ounce. Price goes to $31. They're earning 95 cents per ounce on that lease. Banks have no economic interest in lower price. Banks have economic interest in a higher price, not because they have a naked long position that will be worth more when the price rises, but because their banking services will do better. They're not naked long, they're not naked short. They're kind of, on the first instance, price neutral. They're fully protected, and rising and falling prices don't affect them directly on a primary level. But insofar as they're charging a percentage of the value of the transactions and the leases that they have, higher prices mean higher profits for the banks. So if you go to a court of law and you say, hey, these banks are manipulating the price to suppress it, you're saying their defense is, well, various things. Where's the evidence? There's none. Second thing they say is, why would we act in our own worst interest? Our own best interest is served by having someone like Eric Sprott going around saying, let's bankrupt J.P. Morgan and drive up the silver price. Because when he did that, back in 2010, 2011, J.P. Morgan had record profits in their gold and silver trading that year. Thank you very much. You didn't bankrupt me. You gave me record profits. And Sprott knew that. He was playing the investors who were gullible enough to believe him because he wanted to scare them to buy into his ETFs that he was rolling out at that time. Here's the actual commitments of traders. On the left-hand side are non-commercial, and you can see they primarily trade from the long side. Back in the 90s, which was a very bearish time for gold, they were trading net short. And you can see on the right-hand side the commercials, who were trading net long at that time. Because if the investors wanted to be net short, someone had to be net long. And commercials provide that liquidity. You want to buy? I'll sell. You want to sell? I'll buy. After around 2000, pretty bad time in the world, CPM Group issued a buy recommendation for gold, a long-term buy recommendation for gold in November of 2000. Investors started trading gold from the long side, and they started trading more and more gold. They started trading record levels of gold futures and options. We're talking 30, 40 million ounces of gold futures and options that investors wanted on a gross basis, while other investors were also still shorting the market. The commercials, kind of a mirror image. Gee, I wonder why that is, Wally. The commercials were providing the liquidity on the other side. And because of the increased physical activity at that time, they also had increased physical metal that they needed to hedge. Symbiotic relationship. Silver, exactly the same thing. You see the mirror image. You wonder why the mirror image is there. It's because the commercials are taking the other side of the transactions that the investors want to make. It's not that the commercials drive the futures markets the way some of these people, promo boys, I think we call them, say. The commercials actually are reacting to the investors. If the investors want to buy, the commercials will sell. If the investors want to sell, the commercials will buy. It's that simple. So when people talk about the long and short positions of commercial driving the price up and down, they've got it exactly wrong. The commercials are, to a large extent, passive participants in the futures markets. Now, which is correct? The price tells you which is correct. The analysis that I lay out and that I've lived with for 40 some odd years in these markets, and that every other group that is actually involved in the commodities markets tells you that the commitments of traders of commercials and to some extent longs, investors don't set the price in the long run. And they're not as important as the promo boys would have you believe. They're offsetting their long and short positions for investors. It reflects the trends and levels of long and short positions in the physical markets. And consequently, the commercials positions should neither be expected to blow up nor to send prices sharply higher. There's no big naked shorts. And for 40 some odd years in my career, and even longer in the history, the long positions of commercials have not blown up, and they haven't sent prices sharply higher. Now, you could say, well, that's because they're manipulating the market. But no, a rational analysis is these positions are important in determining the price. There aren't naked shorts, and you won't find them blowing up and sending the price sharply higher. The flip side, which I'm supposed to be playing devil's advocate, is spurious nonsense. Let's be honest. These guys don't know what they're talking about, or if they do know what they're talking about, they choose to ignore it because their business is touting gold and silver to investors who don't understand the markets. Some of these absurd claims have been made since the 1980s, starting with a person who had been banned for life by the CFTC for illegally trading his clients' accounts. He alleged to the CFTC and to the Attorney General of the state of New York and to the senators and congresspeople from Idaho that the bullion, the trading company, it was an investment bank that he was a broker at, was jerking around the silver market. They investigated it. They found a couple matched trades, which were common back then because you didn't have ETFs. And they find that investment bank, I think, $600,000 for that. And then they hung this guy out because he was basically bad. He couldn't get a job in the financial markets, so he became a silver promoter. And since at least 1989, he has been telling anybody who will listen that there's this massive naked short position which is designed to suppress the silver price, but it's going to blow up. And it was Drexel that was doing it, but no, Drexel got out of business and went bankrupt, so it must have been Merrill Lynch that was doing it. And then Merrill got out of the business, so, oh no, it must be JP Morgan. And now it's, oh, maybe it's Bank of America. And it's all nonsense. And the market has never blown up. The price tells you the thesis is wrong. All you have to do is look at the price of silver or the price of gold, and you can say, wow, the thesis that there are these naked shorts that are going to blow up is incorrect. And then you have to say, why would they do it anyway, since they have the largest positions in gold and silver in the world? Why would they do that? It's in their own worst interest to have these markets blow up. It's not going to be there. They've been there for 40 some odd years. They've been long. We had a silver mining client that was getting letters from these guys back in the 80s, and the mining client asked us to work with them and help see what they knew, see if there was something there, and if not, explain to these guys where they were wrong. And my analysts spent way too much time trying to talk to this guy, and they said, Jeff, we're just beating our head against the wall. This guy does not want to know how futures markets work. So we told the mining client, you've already paid us thousands of dollars to try to speak rationally with this fellow, and we're going to stop because there's no value in continuing, because he simply doesn't want to hear it. When we mentioned this in a video in 2008, he threatened to sue us and said he had never accused Drexel of being involved. So we posted on our website a letter that he had written to the then Attorney General of the United States saying, hey, I can show you how Drexel is doing this. Haven't talked to him since. So to put it all together, let's see what my next slide is. My next slide is one last question. To put it all together, I've outlined how we look at the commitment of traders' reports. You look at these other guys and they say these are massive naked short positions that are going to blow up and send the prices higher. They've been wrong for 40 years. They don't understand, or they refuse to admit, that these are not naked short positions. These are hedges of physical market activity, that the banks actually are long physical gold and silver to a very large extent and have a vested interest in higher prices. So you want me to try to play the devil's advocate and say, this is what they're saying. This is what they're seeing. This is what they're saying. And it's all wrong. Okay. Already gone on way longer than I want. One last question that we got was, and several people have said, why don't you ever admit that banks selling billions of ounces of short in the paper market push the price down? Well, 4 responses. First, because it doesn't happen that way. Second, because it doesn't push the price down. Third, why don't you wonder why the banks or some other entities buying billions of ounces in the paper market push the prices up? Because every ounce sold short is also being bought long. Your question, focusing only on the short side of the market, reveals a desperate search for confirmation of a baseless opinion that can be dispelled and ignored with even a basic, simple knowledge of how all commodities markets work. And I hate to be rude, and I hate to be blunt, but I could have been talking about the bond market, about inflation, about the PCE, which came out today, about our outlook for gold, silver, platinum, palladium. But instead, I've just spent 28 minutes talking about stuff that really doesn't need to be talked about. So I'm sorry if I'm blunt. And maybe some people can spend some time at a library or reading the good parts of the internet and stop asking questions that ought not to even be answered. They're irrelevant. I've mentioned a few times we did 2 market alerts, which we sent out to our clients in October. One, October 11th, on our long-term economic outlook. It's about 9 pages long. And one that we released, this week, the 25th of October, which was 10 pages long on deficits, debt, and gold. If non-clients are interested in receiving these reports, they should become clients. If you do, we will also include a market alert that we did on September 12th on the myth of the dollar, the de-dollarization, and why it's not happening. That's all I have for now. Sorry that I took a half hour of your life. Maybe next week we get to talk about the markets. You can go to our websites. You can buy our reports. You can read other things that are free. You can look at videos. We did an interview this week I think it had to do with fuel cells and electric vehicles. It's all there on our website. In the meantime, take care of yourself, be good to yourself and others, try to do something good for the world, and spend some time on the sunny side of the internet, reading and listening to accurate, fact-based, reality-based, research-driven consulting and advice. Take care.